Good evening, everyone. I think we'd like to get started with tonight's very special Authors on Stage program. I'm Susan LaPerla, the Programming Director for the library, and it really is a pleasure and an honor to present this program to you tonight in partnership with Elm Street Books, the New Canaan Chamber of Commerce, and the Alliance of Business Professionals. This is the second program in a series of 3 programs that we're doing together. The first was a couple of weeks ago with author Larry Doyle in Bed with Wall Street. The next one is next week. It's Wednesday morning at 8 a.m. It's a breakfast with Stephen Roach, whose latest book is Unbalanced, The Codependency of America and China. So I hope you can join us for that program if it suits your schedule. Breakfast will be courtesy of Morgan Stanley, so thank you very much, John, for that. And now I'd like to introduce today's speaker. Today we have Jim Rickards with us, who's here to talk about his latest book, The Death of Money, The Coming Collapse of the International Money System. Oh. We have it both ways, so monetary, since that's what's on the screen. This collapse, by the way, won't be the first. In fact, there have been 3 international monetary system collapses in the past 100 years, in 1914, 1939, and 1971. Jim will explain why another collapse is imminent, who will be most affected by the collapse, and what we can do to head it off. Jim is Senior Managing Director at Tandon Capital Partners, a merchant bank based in New York City, and is Senior Managing Director for Market Intelligence at Omnis Incorporated, a technical, professional, and scientific consulting firm located in McLean, Virginia. Jim is a seasoned counselor, investment banker, and risk manager with over 30 years' experience in capital markets, including all aspects of portfolio management, risk management, product structure, financing, regulation, and operations. His market experience is focused in alternative investing and derivatives in global markets. He has also served as general counsel at several alternative asset management companies and a stock exchange facility, and is expert in fund governance and international fund structures. In addition to The Death of Money, Jim is also the author of the critically acclaimed Currency Wars, The Making of the Next Global Crisis. So please join me in welcoming Jim to New Canaan.
Thank you for that introduction, and it's really a pleasure to be here tonight in New Canaan. I live right next door in Darien, and in the 6 weeks since The Death of Money came out, it was released in early April, I've given presentations like this, been on book tour on 4 continents and across 58 time zones. And someone said, Jim, there are only 24 time zones on the planet. How did you cross 58? I said, well, I did a bunch of them twice, but we're out in Hong Kong and Australia, Jordan, London, Washington, all over. So I feel like a baseball team that's been doing away games, and I get to do a home game because, as I said, it really is great to be local with a local audience. And I thank you all for coming. Our topic tonight, The Death of Money, nice cheery title, but I hope by the end of this we'll have put a little meaning around that, and a little depth behind it, and let everyone know what we mean. But as was mentioned in the introduction, the international monetary system has had these 3 failures in the past 100 years. Interestingly, they seem to happen every 30 or 40 years. You know, the tempo is 1914, 1939, 1971. And I make the point that when this happens, it's not the end of the world. It doesn't mean we all go live in caves and eat canned goods. What it does mean is that the major financial trading powers in the world get together, they sit around the table, and they rewrite what they call the rules of the game. The rules of the game is not my expression. That's an expression that's been around for 100 years. Think of it as the operating system of the international monetary system. It's how nations understand that they should operate in terms of their currencies and any other stores of value that they choose to acknowledge or work by. And they rewrite the rules of the game. And so what I do in the book, and what we'll talk about tonight, is first of all, why is this failure coming? What are the dynamics? What are the things to look for? What will it be like, or how will it play out when it does happen? And probably most importantly, what will the new system look like when, as I say, when China and the U.S. and Russia and a few other countries sit down to rewrite the rules of the game? What will the new system look like? And then kind of back to square one, what can we all do as investors today to position portfolios to survive not only the collapse but also be robust to the new system to come. So that's kind of a quick overview. And so let's start with we'll get to the good parts at the end, but I'll start with all the scary parts. One thing that investors need to understand, and one of the hardest questions I ever get, people say to me, well, Jim, what do you do? And it's a hard question because I do a lot of things, but one way to think about it, imagine a classic Venn diagram, and you have a big circle, and in that big circle is national security, defense, intelligence, diplomacy, and so forth. And then you have another big circle over here, and that's global capital markets, stocks, bonds, derivatives, commodities, currencies, and all that. And picture where there's, in the Venn diagram, where there's two circles intersect. That intersection is my space, really, the intersection of geopolitics and global capital markets. Now, a couple things about that space. Number one, it's getting bigger. Those circles are converging, and the overlap between those two is getting bigger. You only have to look at what's going on in Ukraine and how that affects the stock market to see how geopolitics and capital markets are converging. The other interesting thing is that space is fairly thinly populated in terms of experts. There are brilliant people on both sides of that Venn diagram. It's always makes you very proud, actually, when you meet our three-star generals and our colonels and majors who have 2 PhDs, a master's degree, and speak 4 languages. I mean, they're brilliant people in the national security defense arena, and no shortage of brilliance on Wall Street. Probably, sure, quite a few practitioners in the room, the PhDs and the quants and the MBAs and the very seasoned industry professionals. But the number of people who are completely at ease in both worlds, who can go back and forth between the Pentagon and the Federal Reserve, let's say, are relatively few, and that expertise is getting more important because the space is getting larger. So that's kind of what I do, and that's what we're going to talk about tonight. I want to start in 2009 with a topic that was really covered in Currency Wars, although there's a lot more about it in the new book, The Death of Money. And in 2009, the Pentagon conducted the first ever financial war game. Now, of course, the Pentagon's been doing war games forever, but this one was different. It was the weapons of choice could only be financial instruments. So you could not use missiles or submarines or drones or anything that would shoot or explode. You could only use stocks, bonds, derivatives, commodities, and currencies, and so forth to attack your rivals and gain power or perhaps lose power in the course of that struggle. The Pentagon didn't need any help from me in terms of normal wargaming, but I was invited as a game facilitator and to help design the game because it had never been done before. We had to say, well, how will we play this? You know, how long will it take? How many moves? What are the teams? And got to participate in all that. And then, fortunately, was able to actually play the game over a couple of days. We did this at the Applied Physics Laboratory. It's a top-secret weapons facility outside of Washington. And I call it playing Risk for adults. It was kind of fun to do. And we had the usual teams that you would expect. We had a Russia team and a China team and a U.S. team. But we also had a team composed of banks and hedge funds because any struggle in financial space, well, certainly those are very large players in those markets, and you can't rule out the possibility that hedge funds and other institutions, certainly sovereign wealth funds, might be working hand in glove with the military assets of a particular country. So we had a team for those. And with some, one of my contributions early on, you say, well, who is there? There were people, uniformed military, people from the intelligence community, people from the Treasury, the Federal Reserve, you would expect that, and also people from think tanks and universities, what I call the usual suspects when you're doing these kinds of things in Washington. And I was persistent and ultimately persuasive in getting them to invite a few honest-to-goodness Wall Streeters, people who ran hedge funds or from some of our primary dealers, private equity funds, et cetera. I said, look, warfare is all about deception and manipulation. Who knows more about that than people from Wall Street? So we got a couple of real live capital markets people in there. And with some colleagues, we cooked up a plot where Russia and China would pool their gold reserves and deposit their gold in a vault in Switzerland and would create a new bank in London that would issue currency backed by that gold. And the kicker was that henceforth, if you wanted Russian natural resource exports or Chinese manufactured goods, you had to pay for it in this new currency. In other words, they were turning their back on the dollar, undermining the role of the U.S. dollar as a global reserve currency and as a global store of value and medium of exchange. It was fair to say this was met with actually outright ridicule. Some of our friends from Harvard, one guy just laughed in my face. said, this is ridiculous. Why are you doing this? Don't you know that gold has no role in the international monetary system? It hasn't for a long time. It never will again. The usual barbarous relic comment from John Maynard Keynes in the 1920s. But we did it anyway. We went ahead. And in this war game, as I mentioned, you have the teams. You have the red cell and the green cell. Maybe Russia is the red cell and the U.S. is the green cell and so forth. But you have a white cell. And the white cell are the referees. They're the ones who actually observe the action and score points. So they will add power points or subtract power points and let you know how you did as the game progressed. So anyway, we launched this move with the new gold-backed currency, as I described. And the white cell said, we consider that illegal move. That's an illegal move in this game. And we jumped up out of our seats and said, what are you talking about? This is a war. How can you have an illegal move in a war? And it was sort of like an NFL referee. They caucused. They came back upon further review. They said, okay, it's not an illegal move, but we think it's stupid. So we did it anyway, and we played it out. And I came back after a couple of days, and I said to my wife, I have good news and bad news. I said, the good news is that my team won. Bad news is I played China. So that's kind of how it sorted out. This is all described in the first couple of chapters of Currency Wars. But here's the point. Since 2009, Russia has increased its gold reserves by 70%. China has increased its gold reserves by 300 or 400%. No one knows the exact number because they do it through stealth. They're non-transparent about how much gold they're acquiring. But we do have data points. We have mining output in China. We know the imports that are coming in through Hong Kong. We know that they're using back channels, some anecdotal sources, et cetera. And so you can form some reasonable estimates about China's gold reserves, even though they officially lie about how much they have. So things are actually playing out the way we warned the Pentagon in 2009. And next Sunday, Vladimir Putin is going to Beijing to conclude the largest energy deal in the history of the world. This is a 20-year take-or-pay contract between Russia and China to supply Russian natural gas and oil to China, and the dollar is not invited. This transaction will be denominated in rubles or yuan. They'll be obviously accepting each other's currencies in payment, and then they can use those to buy other things. So in terms of the actual action on the ground, acquisition of gold, turning the back on the dollar, things are playing out the way we described. Now, no one said that, admittedly, our scenario was a bit forward-leaning. No one thought it would happen the next day. And the whole purpose of a war game, of course, is to stretch and think outside the box and, as I put it, give the Pentagon their money's worth. But we'll see who has the last laugh on this. But so far, events in the real world are corresponding to what we kind of laid out 5 years ago. So this is being taken seriously. And as I say, there's a whole chapter in the new book on this with a lot more kind of up-to-date information on this, which we can turn to now. So what are some of these real-world threats? Not the hypothetical war game threats, but the real-world threats to the dollar that are going on around us. I'll start with our friends, the Saudis. My first meeting in the White House on official business was in 1974. I met with Helmut Sonnenfeld, who was the Deputy National Security Advisor to Henry Kissinger, who was the National Security Advisor, and there was a small group of about 5 or 6 of us, and we sat around Dr. Sonnenfeld's office, and we discussed the possibility of the U.S. invading Saudi Arabia to secure the oil fields. Then we would establish a military perimeter. We would pump the oil, sell it at a price we liked. We'd give the Saudis the money. We wouldn't steal their money, but we would sort of control the oil market. You'll recall this is at a time when you had to wait a few hours if you were lucky and maybe a full day if you were not so lucky to get a tank of gas. The price of oil was in the process of quadrupling. The global economy was in turmoil. The stock market crashed in 1974 after a pretty good run-up in 1973. There was serious concern that we wouldn't be able to get oil at all, and this was one of the contingency plans. Now, fortunately, that particular plan was never acted upon, but what did happen was that Henry Kissinger concluded what's called the petrodollar deal with the Saudis, and it works like this. We, the United States, guaranteed the perpetuation of the House of Saud. I would say the national security of Saudi Arabia. They're not a nation, they're a kingdom, but we guaranteed the kingdom's security, and they agreed to price oil in dollars. They didn't have to do that. There's no reason why oil has to be priced in dollars. It could be priced at the time in Deutschmarks or yen or Swiss francs or gold. Today it could be priced in euros. It could be priced in a lot of things. But by requiring it to be priced in dollars, everybody in the world needs oil. And if oil is priced in dollars, then everyone in the world needs dollars. You need the dollars to buy the oil. So even if your economy is not otherwise geared or oriented to the U.S. dollar, you had to have them to buy the oil, and you build up dollar reserves the same way you build up oil reserves. So this was a very important prop under the dollar, put a floor under the dollar in terms of its use as the global reserve currency. In December, last December 2013, President Obama stabbed Saudi Arabia in the back, basically tore up this deal by anointing Iran as the regional hegemonic power in the Middle East. Obviously, there was a détente with Iran. The president green-lighted their nuclear ambitions. Last time I checked, the centrifuges were still spinning. Their nuclear reactor, Bashir, was still humming. That reactor produces plutonium, which is only good for one thing, which is basically building atomic weapons. And so Saudi Arabia looked at that and said, okay, you've now green-lighted Iran's regional ambitions at our expense. You've turned your back on the petrodollar deal. You're not holding up your end, so there's no reason for us to hold up our end. So the Saudis are now, again, doing bilateral deals with China, but I expect in the future, increasingly, oil will not be priced in dollars, and that will be, again, turning their back on the dollar and undermining this, what I call the petrodollar deal. Let's go over to our friend Vladimir Putin, and of course he observes this very carefully. We're in a financial war with Russia right now. We're in a war with Russia. It's not a shooting war. It's a financial war. We all know that Russia, took over Crimea. By the way, one of the first things that happened, the two biggest banks in Russia, Sberbank and VTB or Vneshtorgbank, went in and they stocked all the ATMs in Crimea with Russian rubles. So if you go there today, put your ATM card in the machine, rubles are going to come out. So there's currency wars in action. But so Crimea's lost. Nobody, left, right, or center, thinks that there should be a military response to this. Nobody thinks the 82nd Airborne is going to jump into Sevastopol anytime soon. But the United States does not want to be seen to be lying down. So we're responding with economic sanctions, which is just a form of financial warfare. Now, as an aside, we have been in a financial war with Iran since 2012. And there was actually our success in the financial war that led to the negotiations, what I call the détente with Iran that started in December, that has alienated the Saudis. But going back to 2012, the United States kicked Iran out of the dollar payment system. All dollar transfers anywhere in the world run through a system that we control through the Fed and the Treasury called FedWire. And if the United States says you're out of that system, you're out of that system. You can't get dollars, maybe paper dollars in a suitcase, but not enough to run an oil economy. But Iran said, fine, no worries, we'll just transact in euros. There's another system in Belgium called SWIFT. That's the international payment system, message traffic system. And Iran started pricing oil in euros, and the U.S. got together with its European allies, and we kicked Iran out of SWIFT. Now, this was serious because now Iran could ship oil, but they couldn't get paid. They couldn't get paid in anything that you would want, any currency that you would want. They started immediately doing workarounds. They did barter deals, gold for oil, oil for wheat, oil for gold. They had put about $30 billion in Chinese and Russian banks on a precautionary basis, and those Chinese and Russian banks act as fronts for Iran. So when you run this money through SWIFT, this little form you fill out, and it's like sender, recipient, account number, amount, currency, et cetera. And there's a line at the bottom for beneficial owner or party in interest, and the Russians and the Chinese conveniently leave that line blank, but it's actually for the account of Iran, but nobody wants to dig too hard on that. But that's kind of second best because Iran's then hostage to China and Russia in terms of their currencies. They did other deals. They shipped oil to India. They could get paid in rupees in an Indian bank. If an Indian buyer wants to deposit rupees in an Indian bank, that's a local currency transaction. It doesn't have to run through these other payment systems. But all you do is pile up a bunch of rupees. What are you going to do with those? I'm not sure how much curry the Iranians need, but there's a limit to that. So as I said, Iran was pretty desperate, and what happened was the Iranian people started pulling their money out of the bank to buy dollars on the black market. That caused their currency to collapse because the black market dollars sold at a premium. A lot of dollars are being smuggled in from Iraq because actually Iraq does have a lot of dollars. This caused a run on the bank. The Iranians had to raise interest rates sky high to try to keep the money in the bank. The currency collapse caused hyperinflation. People were trying to get dollars to pay the smugglers in Dubai to bring the iPhones in from into Port Bandar and so forth. So the whole place was falling apart. You had sky high interest rates, run on the bank, hyperinflation, black market, we were very good at this. We were getting very close to regime change, or at least destabilizing the Iranian regime without firing a shot. Again, in December, the president relented on that, basically alleviated or pulled away some of the sanctions, freed up about $30 billion that was suddenly made available to the Iranians. So let the Iranians off the mat. Don't think Vladimir Putin wasn't watching. So Putin's watching all this. He sees, a red line in Syria is actually not a red line, and sanctions in Iran are actually not sanctions, because when push comes to shove, you alleviate them. So he goes into Crimea. So now we're in a financial war with Russia, with Putin having taken a few notes from our financial war with Iran. Now, the best way to understand this is to put it in the same game theoretic context that applied to the Cold War. So you go back to the 1960s and the 1970s and nuclear warfighting scenarios, and under the game theory at the time, you had I'll say it was the Soviet Union then, but I'll say Russia because it really was Russia. So the United States had enough missiles to wipe out Russia. Russia had enough missiles to wipe out the United States. That is a highly unstable situation, because the temptation is to shoot first, wipe out the other guy, and you win. And so both sides engaged in an arms race. They said, we're going to build up more and more missiles so that we create what they call the second strike capability, which meant that one company or one country could fire their missiles and wipe out the other country, but they'd have enough missiles left to shoot back and wipe out the attacker, and they would both be destroyed. This was called mutual assured destruction, or the MAD, or MAD doctrine. And believe it or not, the MAD doctrine was actually more stable than the earlier version of that. And this is why this explains a lot of things like the Cuban Missile Crisis and the arms race and all of that. Flash forward 50 years. We are now in the age of mutual assured financial destruction. There's a big difference between a financial war with Russia and a financial war with Iran, which is that Russia has a much greater capability to strike back and to fight back. And you have to be very careful about escalation. Now, the initial sanctions were very tame. It was, a couple oligarchs were not going to get to go to the Super Bowl next year, and there's some Russian bureaucrats who probably they get to Geneva and their credit cards don't work. But beyond that, we didn't do the serious things we could have done. We could have kicked the Russian banks out of the payment system. That would be serious. Most commercial transactions or consumer transactions in Russia clear through Visa and MasterCard. We have control of those companies. So there's a lot of things we could have done that we didn't do. But the reason is, if we escalate, the Russians are prepared to escalate, and they're perfectly capable of this. What could the Russians do? Well, they could freeze U.S. assets in Russia, and there are plenty of those. They could dump their treasury bills, treasury notes, drive up our interest rates, sink our stock market and our housing market just by driving up the interest rates. And beyond that, they could unleash their hackers and close the New York Stock Exchange. And I say that, and people go, well, they couldn't really do that, could they? And I say, well, what happened August 22nd, 2013? The NASDAQ was closed for half a day. We've never been given a credible explanation as to why that exchange shut down. And if it was some technical problem, why don't they tell us? And if it was Syrian or Iranian or Russian hackers, there's a good reason they're not telling us, because it would scare every investor in the world. By the way, yesterday, the New York Stock Exchange was disabled for about 4 hours in the middle of the day. It was like letters, tickers like D through K or something. It was just partial. But, these things, Iranian and Russian hackers, is it the ghost in the machine? My point is, the Russians are perfectly capable of this. And then people say, well, wait a second, Jim, our hackers are just as good as their hackers. Surely we could shut down the Moscow Stock Exchange. And I say, of course we could, but who wins? Moscow Stock Exchange is irrelevant. It's a peanut in global capital markets. The New York Stock Exchange is the heart of the whole system. So they shut down our exchange, we shut down their exchange. Who wins? So this is where you're going to end up. You have to be very careful you don't escalate into that to begin with, or at least understand what you're doing. One of my concerns is that Russia understands this perfectly. I mean, chess is the national sport of Russia, so they're just always thinking 3 or 4 moves ahead. I'm not sure the White House does. There's a lot of kind of brave talk up on Capitol Hill, a little bit coming from the White House. But, game theory works if both sides are playing the same game. But if one of them's not, it can lead to blunders of the kind that caused World War I. And then beyond that, there's another threat. Even if both sides are a little bit cautious, when you're messing around with this stuff, you have to be very careful about accidentally starting a war. You go back again to the Cold War. The 2 most, I think, provocative movies of that time about nuclear warfighting, one was with Henry Fonda called Fail Safe, and the other one was Peter Sellers called Dr. Strangelove. And in both of them involve nuclear wars. One started by accident, the other one started by a breakdown in the chain of command. But the point is, when you're gearing up to fight these kinds of wars, things can happen by accident. So as if all of us as investors and portfolio managers or people managing our own net worth didn't have enough to worry about, here's an extra layer of things that are out there on the horizon. So watch this space. It's happening. This is not theoretical. There's a financial war with Iran going on that's in a little bit of a ceasefire right now. There's a financial war with Russia that's active. Hope it doesn't escalate too far. As I say, Putin's going to Beijing next week, so there's a lot going on in the space, and it's all, as I say, it's covered at great length in the book, so I hope you enjoy that part of it. I'm going to skip ahead over the currency war part, just in the interest of time. I want to spend a couple minutes on a science lesson, because I think the science is important to understanding global capital markets. In 1962, Thomas Kuhn wrote a book called The Structure of Scientific Revolutions. And this is where he introduced the concept of the paradigm shift. And I really hate cliches. I try never to use them. And paradigm shift, unfortunately, has sort of, its original meaning as Kuhn intended it has been somewhat diluted, and people use paradigm shift for all kinds of things. They say, you know, I'm wearing a different pair of shoes today. I've got as a paradigm shift. But in fact, Kuhn meant something much more profound. We have our kind of interface with reality, and then people build models around that. But your paradigm, and that sort of ontology of how you understand things, the paradigm is actually above the model. A paradigm is your worldview. It's how you think about the world as a basis for beginning to model it, as a basis for beginning to engage in action in that world. And Kuhn made the point that history of science advances through paradigm shifts, but they don't happen quickly. There's so much institutional and behavioral inertia in the old way of thinking that when the new way of thinking comes along, it's not an aha moment where a light bulb goes on. It's actually very difficult to get leading lights and leading powers to change the way they think. And so that was really his point, that science is not a slow, steady progression. It moves in these sort of jerky motions, but there's a lot of inertia, and they take time to play through. So I want to use the same illustration Kuhn used to explain how this works. With the cosmology of Ptolemy. The Ptolemaic understanding of the universe, or cosmology, was the prevailing view for 1,500 years. It was sort of articulated in the 1st century AD and prevailed until the 16th century AD. And it was a fairly straightforward concept. Everyone knew that the Earth was the center of the universe, so that was obvious, and that's where it started. And the sun, the moon, the stars, and the planets all revolved around the Earth in concentric circular orbits. And this was very clear, because if you were on the Earth, you know, the sun came up over there, and it went down over there, and then the next day it came up over there again, and obviously the sun was revolving around the Earth. That was clear. And they built these models, and as I say, this view prevailed, and it was added to. And it's not like people were stupid in the 13th century. You know, we had Thomas Aquinas and Thomas More and Dante, you know, plenty of geniuses throughout history. But the best minds and the best scientists and the best mathematicians worked on this paradigm, and they did the math. But a funny thing happened on the way to the planetarium, so to speak, is that as the empirics improved, they noticed that the planets weren't always where they were supposed to be. They were supposed to, remember, they were supposed to be in these big counterclockwise circular orbits. But here's an illustration of, here's Saturn. Now this yellow line here, this is the intended path of Saturn. This is the circular path of Saturn around the Earth. There's the Earth, there's Saturn. But they would notice that Saturn was over here. It was supposed to be here. Now, as a scientist, when you observe data that contradicts your thesis, your theory, you're supposed to question your theory. You're like, well, yeah, maybe my theory's not right. But what the best minds of the time did is they said, well, that's okay, because we understand that actually, in addition to these big circles, there are these little circles. And they called the little circles epicycles. And they said there are little clockwise epicycles on top of the counterclockwise cycles, and that explains the kind of wobbliness of the planets and why they're sometimes in a different place, because they're doing this. And then they did the math, and they got more and more complicated. And over here you can see an example of cycles, and it kind of does this loop-to-loop little pattern around there and keeps going, and then it was all good. Well, needless to say, the math kept getting more and more complicated, and the work kept getting more and more complicated. They were racking their brains and building these models. At no point did anyone ever say, you know, maybe our whole way of thinking about this is junk, until Copernicus came along. Copernicus said, you know, maybe the sun doesn't revolve around the Earth. Maybe the Earth revolves around the sun, and the sun is actually the center of the solar system. Tycho Brahe and Johannes Kepler and others worked on this problem over the course of the 16th century. And by the end of the century, they had worked out a new cosmology which said that the sun is the center of the solar system. This is the heliocentric theory, and that the planets revolve around the sun, and they do so not in circular orbits, but in elliptical orbits that are not even concentric, because sometimes certain planets are closer than other planets at different times. And guess what? This was correct. This worked, and all the math worked, and they didn't need wobbly circles and epicycles and all that. So that's the end of the science lesson, but I want you to bear this in mind when I talk about the Federal Reserve, because the Federal Reserve is working with models that say the Earth is the center of the universe, and they will always get the policy wrong, and they will always get the forecast wrong as long as they're working with the right model. So I want to suggest that what's going on in economics today is a paradigm shift. We're in the process of abandoning an entire way of understanding capital markets that is completely at odds with reality, and embracing a new model that is in sync with reality. But this is a long process. It's going to take 20 or 30 or 40 years. I actually don't think the system will make it that far. I think it'll collapse before the good science comes in. But this is a good way to understand economics. We're in a library, so I want to pay tribute. We had to do a little literary excursion here, but pay tribute to one of my favorite authors, F. Scott Fitzgerald. And Fitzgerald said something in 1936 I think is important to understanding the economy. He said, "The test of a first-rate intelligence is the ability to hold two opposed ideas in mind at the same time and still retain the ability to function." And big emphasis on that last clause. You gotta be able to function. And I want to suggest that investors have to have two opposite ideas in mind at the same time if you really want to understand what's going on. And those ideas are inflation and deflation, because people will talk about inflation all day long. We're worried about inflation. Inflation's right around the corner. When it comes, the bond market's going to crash, and the bond market's a bubble, blah, 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 blah. And then a smaller number, but still some very astute analysts, are focused on deflation. They say, you know, the disinflation is getting stronger. It could tip into deflation. This actually explains why the bond market is rallying, notwithstanding the fact that everyone's calling for a crash. And I want to suggest that both things are going on at the same time, and that's why it's very difficult to sort out, and you have to keep them both in mind. The deflation comes from the fact that we're in a depression. We are in a global depression. It began in 2007. It will continue indefinitely. And when I say that, people go, oh, wait a second, depression, that sounds a little scary. People don't know what a depression is. They assume that a depression means continuously declining GDP, but that is not the definition of a depression. A depression means you can have growth in a depression. We had good growth in the U.S. economy from 1933 to 1936 in the middle of the Great Depression. A depression, you can have growth, but the growth is below trend. It's below potential. And it's that gap between your potential growth and your actual growth that represents depressed growth, and that's what a depression is. So if the long-term potential growth of the United States is, say, 3.5%, which it is, and if the short-term potential is 5 or 6%, in other words, in the short run, you can actually grow above your long-run potential by bringing people back into the labor force who have dropped out of the labor force. So if your trend is 3.5%, your short-term potential is 5.5%, and you're growing at 1 to 2%, which we are, that's a depression. It's depressed growth. And that gap between the 3.5% trend and the 1 to 2% actual is lost wealth. And it gets bigger over time, and you never make it up. The best you can do is get back to trend if you're lucky, but you never make up that lost wealth, and as I say, it gets worse over time. That's what a depression is, and that's exactly empirically what we're experiencing right now. And by the way, that definition is not my definition. It comes from John Maynard Keynes, and it's good enough for him, it's good enough for me. But that's how you can understand what a depression is. When you hear all the talking heads on television say, you know, we don't understand why this recovery is not stronger. We don't understand why the recovery is not more robust, and all this is 5 years into it, it's still weak, blah, blah, blah. Well, it's not a recovery. We're not in a recovery. We're in a depression. And you have to be 90 years old. I don't anybody in the audience 90 or older? So sometimes, you never know. do Darien Senior Men's, and we get a couple 90-year-olds. But you have to be 90 years old to have a living memory of a depression and deflation. None of us do. But if you've heard about it from your parents or your grandparents, and you're wondering what a depression feels like, this is it. It feels crummy. It doesn't feel like the world's falling apart, but it doesn't feel really great either. It's just kind of, I don't quite get it. And what the models that people are working with are these cyclical models. In other words, the economy is rock and rolling, unemployment's low, wages are going up, inflation's going up, it gets a little hot, the Fed tightens, it goes back down, unemployment goes up, industrial production drops, prices drop a little bit, it cools down, the Fed says, okay, enough, they loosen, it goes back up again, and you get this nice sine wave, expansion, contraction, which is exactly what the economy experienced since World War II. Depressions are different. Depressions are not cyclical. They are not amenable to cyclical monetary solutions. Depressions are structural, and they remain in place until you make structural changes. In other words, you cannot solve a structural problem with a cyclical solution. You need structural solutions. What are structural solutions? They're things like fiscal policy, capital gains tax, Fair Labor Standards Act, Keystone Pipeline, environmental regulation, health care, et cetera. These are things that are the province of the Congress and the White House or parliaments around the world. They are not the province of the Federal Reserve. So the Federal Reserve is trying to solve a structural problem with a cyclical solution. It won't work. It's failed for 5 years in a row. And by the way, don't ever think for a second that the Fed knows what they're doing. They absolutely do not. I've had one-on-one private conversations with members of the Federal Open Market Committee and also central bankers from around the world. And privately, they will tell you that they don't know what they're doing. They're making it up as they go along. It's a big experiment. We're the guinea pigs. They won't say this publicly, but as I say, they will say it privately. And it's also, I have heard it from them, but you don't need to hear it from them. You can just look at the fact. The Fed has had 15 separate policies since 2009. They have what they call forward guidance. I call it propaganda, but they've had forward guidance where they tell you what the rates are going to be. Well, they said we're not raising them until 2013. First they said extended period, then it was 2013, then it was 2014, now it's 2015. They had QE1, QE2, QE3. QE is quantitative easing, which is a fancy name for money printing. QE3 came in 2 different flavors. Now they're tapering. They had Operation Twist, currency wars, all this stuff. So if you have 15 policies in 5 years, you don't know what you're doing. You're just making it up as you go along, and that is exactly what the Fed is doing. So we're in a depression. It's structural. That's where the deflation comes from. The inflation, remember I said there are two forces pushing against each other. The inflation comes from policy. It comes from printing $4 trillion in the last 5 years. So you've got kind of inflation from policy, deflation from structural damage to the economy, pushing against each other. And the actual price indices are pretty stable. They're right around 1%. But it's exactly like being on a fault line. You've got massive tectonic plates pushing against each other. It's going to snap. It could snap either way. It could snap into something like hyperinflation or serious deflation and a much worse depression. But it's not a stable situation. I was actually out in the California desert not long ago, and I stood on the San Andreas Fault. You can see it because if you're in the desert where the fault runs, it's a crack in the earth, so the water percolates up. So there's a green strip of vegetation in the middle of the desert, and that is the San Andreas Fault. And you can go out and put one leg on either side of it. The day I did that, nothing was happening. It was perfectly still. It was a nice day. But that doesn't mean it's stable. We all know what's going on underneath, and that's how you can understand the economy today. We're in a highly unstable situation, kind of calm on the surface, forces building up, a massive collapse waiting to happen. That's just a matter of time. Want to just spend 1 second on the quantity theory of money. You all learned this in your first week of economics, but it's an identity or an equation, M times V equals P times Q. M is the money supply, so how much money is there? V is velocity. Velocity is the turnover of money, so if I go out to a restaurant tonight and tip the waiter, and the waiter takes a taxi cab home, and the taxi driver takes the fare and puts gas in his car, that dollar has velocity of 3 because it supported $3 of goods and services, the tip, the taxi, and the gasoline. But if I stay home and watch hockey and don't go out, my money has velocity of 0 because I'm not spending it. So it's basically how much money is there, how fast is the turnover. That equals the notional value of this notional gross domestic product. So all the goods and services in the U.S., that has two parts. There's the real part, which is the Q, and the price part, the price index, inflation or deflation, which is the P. So Milton Friedman looked at this and he said, well, this is a trivial problem because Q can only be about 3.5%. In a mature economy like the U.S., you really can only grow about 3.5%. That's a pretty good growth rate, but that's the best you can do. It's just labor force participation times or plus productivity, so that's all it is. So that can only be 3.5%. You want that to be 1. Any number times 1 is itself, so you want the price index to be 1. That means no inflation, no deflation. Friedman assumed that velocity was constant, so he said monetary policy is a trivial exercise. If this is 3.5%, and this is 1, and this is constant, all you have to do is grow this at 3.5%, and you'll have maximum real growth and no inflation. That is central bank nirvana. That's as good as it gets. So I used to joke that we don't need a Federal Open Market Committee. We just need a computer to bang out, print money at 3.5%, and it's all good. So let's see how this is working in the real world. Here's the money supply. Now, what you see from 1975 to 2009, the money supply grows the way Milton Friedman would have recommended. This is nice, steady, slow, incremental growth, exactly what Friedman would have expected. This is QE1. The Fed takes their balance sheet from $800 billion up to about $1.6 trillion. They doubled their balance sheet in about a year. Then they turned it off, kind of went sideways a little bit. This is QE2. Started in November 2010, ran through June 2011. Then they stopped it, and then they came back with QE3 in September 2012, and this is QE3. I try hard to update these charts, but the Fed actually prints money faster than I can update the charts. So the actual number is up here. The Fed balance sheet is about $4.1 trillion. If I came back in 6 months, it would be up here. You know, eventually I'll need one of those Al Gore scissor lifts to go up here. But this is what's happening to your money supply. So, so wait a second. You know, Milton Friedman said if you increase the money supply by 400%, you ought to get 3.5% real growth and 397% inflation. So where's the 397% inflation? Well, here's the problem. Friedman was wrong about velocity. Velocity is not constant. Velocity is collapsing. And you can understand monetary policy as a desperate race between increasing money supply and decreasing velocity. The M is going up and the V is going down. And the Fed is printing money in a desperate effort to prop up the economy, because if you go back to this, I like to remind people that $3 trillion times 0 is 0. If you don't have velocity, you don't have an economy. So this, the Fed can make it whatever they want. They really can. They can make this whatever they want. But this is behavioral. This is psychological. They cannot change the velocity, but they have to. What the Fed has to do is bend this velocity curve. They've got to get this velocity curve going up. They've got to get all of us in the mood to spend. But this is a psychological behavioral problem. Do you feel good? You know, as Clint Eastwood would like to say, how do you feel? You know, do you want to go out to dinner tonight and take your friends and buy drinks for everyone at the bar? Or do you want to stay home and watch hockey? Well, right now, everyone wants to stay home. No one feels like spending a lot of money or running up the credit cards or borrowing money or home equity loans or all that good old stuff in the early part of the 21st century. But the Fed has got to get us doing that. They've got to get us lending and spending to get the velocity up so the money supply turns into nominal GDP so the U.S. can pay its debts. How are they doing that? They're trying to create negative real rates. A negative real rate is a situation where the rate of inflation is higher than the nominal rate on the bond or nominal interest rate. So if you have 3.5% inflation, but say a 2.5% rate on a 10-year note, then the real rate is negative 1% in that example. Negative rates are a very powerful inducement to borrow. That's better than free money. That's where the bank pays you to be a borrower, because you get to pay them back in cheaper dollars. You know, my first mortgage was 13%, and my mother cried when I told her, but inflation at the time was 15%, and taxes were 50%. So if you have a 13% mortgage in a 50% tax environment with 15% inflation, that's better than free money. You're getting the bank's paying you to borrow. I wouldn't do that trade today, but it worked in 1980. So they've got to get inflation up so we get negative real rates. That's the inducement to borrow. They also have to deliver an inflation shock, and this is where the propaganda comes in. The Fed says ad nauseum, we're targeting 2% inflation, 2%, 2%, 2%. If I promise you 2% and I give you 2%, there's no change in behavior. I've exactly met your expectations, so there's no change in behavior. What I have to do is lie to you. I have to promise you 2% and give you 3%, and that's a shock. Suddenly, oh, gee, better go out and buy a house, buy a car, whatever it is. And I've spoken to Charlie Evans, who's the president of the Federal Reserve Bank of Chicago. He'll say privately they want 3.5% inflation. So this is where the Fed's going with this. They are trying to get 3.5% inflation. And then a lot of people say, well, wait a second. If they get inflation at 3.5, won't the 10-year note go to 5.5? You know, I mean, bond market's not dumb. The answer is no, because of something called financial repression. Financial repression is government intervention to keep a lid on rates. This is why the bond market is not poised for a crash. Or let's put it this way, if the 10-year note goes to 5.5, inflation is going to be 7.5. They got to get inflation higher than the nominal rate. And the way they keep a lid on the nominal rate is quantitative easing. They buy the bonds. They have a bid. I talk to my friends who in the primary dealer community. They're relaxed. They just say, hey, the Fed's got our back. And they do. And by the way, if the Fed balance sheet gets to the outer limit and they can't buy one more bond, they're going to make the banks buy the bonds. You know, these banks all got bailed out in 2008, and they were like, they looked around after the shooting stopped and like, hey, this is a good deal. You know, we get to keep our phony baloney jobs, and we get to make money and pay ourselves bonuses and rip off savers and all that good stuff. Pretty good deal. Well, there's another side to that deal. They're going to find out that they're working for the government, that the government, in effect, has de facto nationalized the banks. In the 1950s, bank balance sheets were 50% U.S. government securities. Today, that number is about 7%. So a lot of headroom between 7% and 50%. So if the Fed runs out of powder, the banks are going to be forced to buy the bonds. That's how they'll keep a lid on rates. They're going to keep printing money until they get the inflation above the nominal rates, create negative real rates, so we all go out and borrow money, get the lending and spending machine going again, increase nominal GDP, get nominal GDP back to trend, make it self-sustaining, withdraw policy, substitute real GDP for nominal GDP, make real GDP self-sustaining. We all live happily ever after. That's their plan. That's their playbook. It will fail, but it's good to know what they're thinking if you're trying to kind of stay out of the way. So here's how they're trying to get the 3% inflation. They cut interest rates. Quantitative easing came in 3 flavors. Communications policy. A friend of mine's in charge of this. I tease him. I call him the Minister of Propaganda. Currency wars, Operation Twist, nominal GDP targets. Maybe next year we'll have a tax cut. That's the helicopter money. As I say, it's a sad thing when a central bank wants inflation and can't get it, but that's exactly where we are today. When Janet Yellen came in, a lot of reporters called me and said, oh, Jim, what do you think about Janet Yellen? Is she another Bernanke? I said, no, she's much worse. Bernanke actually had a practical streak for all his egg-headedness. You know, he did do stop-go. You know, he stopped QE1, he stopped QE2. He wanted to see what would happen. Yellen is much more hard shell, much more model-based. She takes the dual mandate to heart. The dual mandate is the part of the Fed's charter that says you have to maintain price stability and reduce unemployment. She takes that very much to heart. But go back to what I said earlier. She thinks, based on this paper I mentioned here, Erseg and Levin, 2013, it's easy to find. Levin is Janet Yellen's go-to labor economist. He's the guy she listens to when she's trying to figure out policy. So if you want to read Janet Yellen's playbook, find that paper and read it. Levin says 2 things, and they're both very interesting. The first conclusion is that he says the unemployment problem is mostly cyclical. Now, that's incorrect, but that's what he said. And Janet Yellen doesn't listen to me. She listens to Levin. So she thinks it's cyclical. That's a big deal because that means you think you can do something about it. The other thing he concludes is even more interesting, which is that there's a difference between being unemployed and being out of the labor force. Both people don't have jobs. You know, the unemployed person and the person who's dropped out of the labor force does not count as unemployed, by the way. Neither one of those people has a job. But the unemployed person is what you call job ready. They'll take a job if you give it to them. But the person who's dropped out of the labor force is on the couch eating Doritos, watching hockey. And there's a much greater inertial factor. It takes a lot more monetary ease and a lot more action to get that person off the couch back into the labor force. So put all this together. You're Janet Yellen. You think the problem's cyclical. You think that means you got to print more money. You think that a big part of it is the inertia of being out of the labor force. That means you got to print even more money. And you think you can do something about it. So her heart is in money printing, but Bernanke tied her hands by starting the taper. Taper means reducing money printing in December, and she's the new kid on the block. And the Board of Governors, the Federal Open Market Committee, they decide this interest rate policy. It's very rigged in favor of tapering. It's supposed to be 7 governors and 4 regional reserve bank presidents, so you have 11 votes, and sometimes you get a 10-to-1 vote or a 9-to-2 vote, but it's supposed to be 11 votes. But there are 3 vacancies on the Board of Governors, so they show up. The governors only have 4 votes, and the presidents have 4 votes, so it's only 8 votes. And the presidents are traditionally more hawkish, And you got two super hawks, Richard Fisher of Dallas and Charles Plosser of Philadelphia, among the presidents, and they rotate. So she doesn't want to tear up policy. She's new. She's only in her third or fourth meeting. The board's weighted to the regional reserve bank presidents who are more hawkish. She's got two super hawks in that group. It's going to be very difficult for her to end the taper, to pause. And if they don't, they're tapering into weakness. We'll be lucky to avoid a recession this year. Watch 2015. The board is going to be much more dovish. The two hawks, Fisher and Plosser, come off. A couple of doves, Lockhart and Evans, come on. The vacancies are being filled by the president, Lael Brainerd and Stan Fisher. They're both doves, and she'll have her feet wet by then. So it's going to be a much more dovish position in 2015. So look for QE4. So that's the deal on the Fed. And so I like to say, here we are. We understand policy. We now know as much as the Board of Governors. And what could possibly go wrong? Well, here's the problem. The Fed looks at that car, and they say, there's nothing wrong with that car. It's clean. It's got 4 brand new tires. The engine's running fine. Full tank of gas. Nothing wrong with the car. But if you apply dynamic systems analysis, we all know what's going to happen to the car. And so this goes back to what I talked about with the paradigm shift. If you've got the old models, you think there's nothing wrong with the car. If you got the new models, you know what's going to happen next. I want to jump ahead a little bit, spare you some of the science, but I want to suggest that the most important question in economics today, the most important question is the following. Are capital markets complex systems? If you don't think they are, you can actually skip the rest of this lecture. But if you do think they are, you ought to hang around, because if they are, then the way capital markets actually work is completely different than the way the Fed thinks they work. The Fed uses what are called stochastic general equilibrium models. A general equilibrium model kind of says the economy normally is in some kind of equilibrium, and things are self-correcting, gets a little too hot, we dial it down, It's like the thermostat in your house, right? You dial it down. If it's too hot, you dial it up if it's too cold. But capital markets are actually complex systems. Complex systems are not equilibrium systems. The Fed thinks if you get out of equilibrium, you apply policy, push it back into equilibrium. It's like winding up the clock, and the clock ticks fine, and it's all good. That's not what we have. Complex systems are capable of shooting off in completely unexpected directions. They're capable of what are called phase transitions. I think the more popular terms are either black swans or tipping points, but a physicist would call it a phase transition. It's when the pot of water turns to steam. If you apply enough heat, it's all H2O molecules, but those are completely different dynamics. So the hallmarks of complexity are these 4 characteristics: diversity, connectedness, interaction, and adaptability. By the way, these are not buzzwords I picked out to fit to capital markets. If you took a course in complexity theory in the physics department of any university from someone who knew nothing about finance, this is what they would teach you. This is what they would tell you about complex systems. Well, let's run the test. Diversity. It's hard to think of anything more diverse than capital markets. You've got millions of players around the world. You've got bulls and bears, fear and greed, long and short, leveraged, unleveraged, all kinds of points of view. Just pick up any newsletter, turn on TV, you'll hear 50 points of view in the first hour. So we've got plenty of diversity. By the way, if you don't have diversity, you don't have a complex system. If we all think the same thing, that's not a complex system. That's boring. But in capital markets, you've got the connectedness. Absolutely. We've got Bloomberg, Dow Jones, Reuters, CNBC, Gmail, whatever. We're probably over-connected, but that's an easy one. Interaction, sure. Trillions of dollars of stocks and bonds, currencies, commodities traded every single day. And adaptability is the last test. And that just means that my behavior is affected by your behavior and vice versa. So we're responsive to each other. That's where all the interaction and connectedness together affects our behavior. And so these are the tests of complexity. I want to suggest that capital markets are 4 for 4. They're actually the ultimate complex systems. And if you understand complexity, you would be very frightened at the state of capital markets today. Kind of want to illustrate this with, do this very quickly. This is what's called a graphical representation of a density function. And this was done by the London School of Economics. And I apologize, you can't see these little dots, but I put these big dots in to illustrate. So these are corporations or corporate players or entities. The blue is technology, dark green is real estate, black is energy, white are basic materials, and light green is finance. So these are the sectors. Every dot represents a company. So one of those dots is Morgan Stanley, one of those dots is IBM. And whenever there's a connection between any two, you draw a line. This was obviously not done by hand. What you do is you identify your 500 or so dots, you come up with your factors, you put all that data into a computer, it's graphical representation software, you push a button, this is what comes out. So look at what's happening between 2003 and 2008. In 2003, we have lots of connections and some density. You would expect that. But these sectors are fairly distinct. You can call it a spider or an octopus or whatever. These 5 sectors are fairly distinct. Look at what's happening from 2003 to 2008. 2 things are happening. Number one, the system is becoming more dense. In other words, the sectors are losing their identity. It's getting more and more of a blob until by 2008, you don't have these distinct arms and legs that you had in 2003. It looks like one big blob. The second thing that's happening is the whole system is being sucked into finance. Real estate has disappeared by 2008. Real estate is completely subsumed in finance, and the other sectors are densely connected as well. Now, here's the point. In 2007, at the beginning of the mortgage crisis, Chairman Bernanke was quoted as saying, "This will blow over." That was his analysis in 2007. When the crisis was apparent, he said this would blow over. A bright graduate student in physics and complexity theory with no knowledge of finance who looked at this graph and looked at that would say in 2008, your system is about to collapse because you are so densely interconnected that a small perturbation anywhere in the system will quickly ripple through and take down the entire system. So how could a grad student in physics get a better forecast than the chairman of the Federal Reserve? The answer is he's got the right paradigm and the chairman doesn't. And this is the importance of complexity theory in terms of understanding what's going on in capital markets. Here's another, by the way, here's what's happening to our banking system. In 2008, what do we all hear about? Too big to fail, too big to fail. Since 2008, the 4 biggest banks in the United States are bigger. They have a larger percentage of the total banking assets. Their derivatives books are much bigger. In other words, everything that was too big to fail in 2008 is bigger today. So look at, by the way, these are all the banks that used to be. These are not small banks. Chemical Bank, Chase Manhattan, Bank One, First Chicago, a lot of big names here. Bank of Nations Bank, remember them? Fleet, Summit, so these are huge banks. They're now all 4. So look at that chart, and then look at that chart, and tell me what's going on with our financial system. And I want to suggest that this is a system that is on the brink of collapse. This is a model. I'll skip that, but I think you all take the point that when you get that much concentration, that much scale, that much density in a complex system, which is what we have, it takes a very small spark to make the whole thing come tumbling down. And as I pointed out earlier, this is something that has happened 3 times in the past 100 years. So when we get to this collapse, the collapse of the international monetary system, what's going to replace it? What will the new rules of the game be? And I've outlined 4 scenarios. One is we have a world of multiple reserve currencies where the dollar is no longer king, a world of SDRs. I'll come back to what those are. That's money issued by the IMF, a possible gold standard, and possible collapse. I don't want to spend a lot of time on multiple reserve currencies except to say that in 2000, 70% of global reserves were in U.S. dollars. Today, that number is about 60%. You can imagine that continuing to trend down below 50 until maybe the dollar is 45%, the euro comes up to 40, the Swiss franc comes in, the yen has a role. We have a whole bunch of global reserve currencies sharing the space. I call this the Kumbaya solution, where we all just get along. A lot of scholars, particularly Barry Eichengreen at the University of California, Berkeley, do think this is the way the world's going to evolve. It might, but I give it a low probability because there's no anchor. There's no gold standard. Even a dollar standard is not a gold standard, but it's a dollar standard, which is what we have from 1980 to 2010. The dollar anchored the system. You can criticize the dollar, but at least we had an anchor. But take away the anchor, I think the whole thing's adrift. So I view this as highly unstable. The second system is the SDR system. SDR stands for Special Drawing Right. Sounds geeky. It's actually very simple. The Special Drawing Right, well, I'll put it this way. The Federal Reserve has a printing press. They can print dollars. The European Central Bank has a printing press. They can print euros. Well, the IMF, the International Monetary Fund, has a printing press also. They can print SDRs, and they can, and they do. These special drawing rights, it's really world money. The reason they didn't call it world money is because that sounds kind of scary, but it is world money. It's the same reason we didn't call the Federal Reserve the Central Bank of the United States, even though it is, because Americans hate central banks. They got rid of 2 of them. throughout our history. So when they devised the central bank in 1913, they said, let's call it the Federal Reserve, so no one will really know what that is. Same thing with the SDR. It's world money. They call it SDR, so no one understands it, but now you understand it because it's as simple as that. And here's the point. Why didn't the world come to a complete halt in 2008? You know, because first we had Bear Stearns collapsed in March 2008, then Fannie and Freddie collapsed in the summer of 2008, then Lehman Brothers in September, then AIG. Morgan Stanley was days away from collapse. Morgan Stanley would have closed its doors a few days later. Goldman Sachs would have been right behind it, then Citibank, then Bank of America. Maybe JP Morgan would have been left standing, maybe not, but all those dominoes were falling. Why didn't those other 4 dominoes fall? Well, the answer is the dominoes were lined up. One was falling after the other, but the Fed dropped a steel curtain between 2 dominoes. The domino hit the steel curtain, and the other domino on the other side didn't tumble. Morgan Stanley did not fail, but that's because the Fed and the Congress and the TARP intervened. They not only printed the $4 trillion that I showed you, they did tens of trillions of dollars of hidden swaps with the European Central Bank. They, with the FDIC, guaranteed every bank deposit in America. They guaranteed every money market fund in America. Pretty big steel curtain. They did it, and it worked. Those other firms did not fail. But they haven't been able to unwind it, and they're out of headroom. What is the Fed going to do the next time there's a global liquidity crisis? And by the way, don't think that's in the distant future, because you go back to October 19, 1987, the stock market fell 22% in a single day. Today, that would be the equivalent of 4,000 Dow points in one day. Not 400, 4,000. That's what happened in 1987. 1994, the Mexican peso crisis. 1997, the Asian market crisis. 1998, long-term capital management in Russia. 2000, the dot-com collapse. 2007, the mortgage collapse. 2008, the panic. These things happen every 4 or 5 years. The next time there's a liquidity crisis, it's going to be bigger than the Fed. What is the Fed going to do? Take their balance sheet to 8 trillion, 12 trillion? The Fed is leveraged 80 to 1. They have about 50 billion of capital and 4 trillion of assets. That's 80 to 1 leverage. They are insolvent on a mark-to-market basis. They look like a really bad hedge fund. And I had this conversation with my friend, the FOMC member, and I was sitting, we were at dinner, 8 of us around a table. I was 1 seat away, and I like to keep the conversation interesting, so I said to the governor, you know, the Fed's insolvent on a mark-to-market basis. And of course, they don't actually mark-to-market, but if you did, they would be insolvent. She said, no, we're not. No one's done that calculation. I said, well, I've done it, and I think others have done it, and I think you're insolvent. And she said, well, maybe. And I just stared her down because she knew I knew what I was talking about. So finally she said, well, maybe we are, but it doesn't matter because central banks don't need capital. So that was the conversation. She went from no to maybe to yes in about 30 seconds. But the point is the Fed is insolvent. And her last remark, central banks don't need capital, tell that to Rand Paul. Rand Paul's running for president in 2016. He has already made this a campaign issue. If you think bailing out banks was unpopular, wait till we have to bail out the Fed. So this is coming your way, you know, Ms. Governor, whether you like it or not. So, so the Fed's at the outer limit of what they can do. When the liquidity crisis comes, which it will, the only clean balance sheet left in the world is the IMF. They're leveraged about 3 to 1. They do have the headroom. They can print, you know, my estimate, 4 or 5 trillion. SDRs, by the way, they've been around since 1969. They've been issued from time to time. The last time was 2009. I think I was the only one who doesn't work, the IMF, who noticed. But they're out there, and this is where the liquidity will come from. And when it does, the dollar's over as the global reserve currency. From then forward, because the Chinese and the Russians will insist on this, from then forward, the SDR will be the global standard. We'll still have dollars, by the way. It doesn't mean the end of the dollar. But the dollar will be like the Mexican peso. It'll be your local walking around money. But the big things, the price of oil and so forth, will be denominated in SDRs. Just spend a second on the gold standard, show you who has the gold. One of the reasons I've been consistently bullish on the euro, 3 years ago, I was the only one in the world bullish on the euro, but that's worked out okay. Europe has the most gold. They have about 10,000 tons. The U.S. has 8,000 tons. Our friends at the IMF have about 3,000 tons. China says they have 1,054 tons, but they're actually up here. They're somewhere between 3,000 and 4,000 tons. They're on their way up here. When this all goes down, as I mentioned, they come around the table to rewrite the rules of the game. Think of it as an international game of Texas Hold'em, as a poker game. What do you want at a poker game? You want a big pile of chips. Well, gold are going to be your chips. I'm not saying we'll automatically have a gold standard. I am saying that gold is going to determine your seat at the table, and that's one of the reasons China is acquiring so much gold. And by the way, these are the implied non-deflationary prices of gold in a gold standard. When I say non-deflationary, what I mean is people say we can't have a gold standard because there's not enough gold. If you look at the volume of money and trade and finance and bank balance sheets, there's not enough gold to support that. And of course the answer is nonsense. There's always enough gold. It's just a question of price. At $1,300, there's not enough gold. But at $10,000, there's plenty of gold. So the point is, you have to, if you're going to have a gold standard or a gold reference, you have to get the price right. Because if it's too low, you're going to have to reduce the paper money supply to maintain the parity, which is deflationary and depressionary. So the implied non-deflationary price, and what these means, this is, because you have to pick a money supply, you know, M1, M2, M3, whatever you want. It matters because they're all very different. So here I'm saying GM1 is global M1. So M1 money supply for US, ECB, and China. So global M1 with 40% backing, not 100%, but 40%. That's $7,000 an ounce. Over here, global M2, that's with 100% backing, that's $44,000 an ounce. I'm not predicting $44,000 gold. I'm actually predicting $7,000 gold. But my point is, when I say that, that's not a made-up number. I'm not trying to get a headline. I'm not trying to be provocative. This is 8th grade math. We know how much gold there is. We know how much money there is. I think I learned to divide in the 8th grade. Maybe it's 6th grade, but whatever. It's just a simple division. These are the numbers you get. So these are the implied non-deflationary prices of gold. And this is where I get my $7,000 gold forecast. The most likely scenario, I think, is collapse. I think through a combination of denial, delay, wishful thinking, and misapprehension of the statistical properties of risk, the Fed actually will drive the car off the cliff, will collapse. We'll muddle through, but the response to that will be executive orders and a kind of neo-fascism. So that's probably the most likely outcome, and then we'll muddle our way back to something like a gold standard, perhaps. We're in the library, so here are a couple books I highly recommend. The Currency Wars was a national bestseller. The Death of Money is a New York Times bestseller. And somehow, to me, national bestseller sounded better, but my publisher assures me that New York Times bestseller is more prestigious, so I'm very happy to say we outdid our younger sibling, but I hope you enjoyed both the books, and I thank you very much. We're going to have a book signing, but I'm happy to answer a few questions if anybody has them. Yes, sir, in the middle, yeah.
So how do we get structural change? Because from what you described, it's going to be a collapse, and then we'll have neo-fascism, which is the only way to get structural.
That's one kind of structural change, right? It's a great question, because one of the questions I occasionally get asked, and one of the questions I ask myself, is what would it take for me to be wrong? So everything I said, just forget about it, I'm wrong. What would that world look like? And the answer is it would be a set of structural changes. So capital gains tax, 0. Corporate income tax, abolished. Personal income tax, lowered. Keystone Pipeline, built. Obamacare, mostly repealed, keep the good parts. You know, et cetera, et cetera. More emphasis on education, not to benefit teachers' unions, but to benefit students. There's a set of things that if they were enacted tomorrow, I would, you know, sell my gold and buy stocks, right? But I give the chance of that as being close to 0. And as I can specify the conditions that would make me wrong, but the probability is close to 0. So how do you break the political gridlock? Well, in democracies, you do it with elections. So see what happens in 2014, 2016. That's a long time the way things are going. I'm not sure we'll make it that far. So that's one footnote I would drop. But even then, I mean, there's no evidence that either party is really committed to the kinds of changes we need. So I'm a little bit, I'm not particularly encouraged on that point. So yeah, it is possible. The point I'm making, I say the difference between currency wars and the death of money, I got to the end of currency wars and I said, it's late, but it's not too late. And here's some stuff that the country can do. At the end of death of money, I said, it probably is too late to save the country, but it's not too late to save yourself. And here's some things that investors can do. So I don't have a good answer other than democracy and elections, but you know as much about that as I do, and we'll see what happens. Yes, sir.
Quick question for you. Speaking of financial wars, DIC data came out today, and we keep having this Belgium coming up with $40 billion a month. Any idea what's behind it?
It's not the Belgians, right? Yeah, just to repeat the question, the Treasury reports foreign holdings of U.S. government securities periodically, and it's what is showing up in these reports, and a new one came out today. But what shows up in the reports, not surprising, is the Russians have dumped 100 billion or more of U.S. government securities, exactly what I described at the beginning presentation. But the total holdings are not going down because, thank goodness, the Belgians are coming in and buying hundreds of billions of U.S. government securities. But everyone knows it's not Belgium. They don't have a current account surplus. They don't have large reserve positions. They actually have a fair amount of gold. They have 230 tons of gold. But so somebody is operating through Belgium. Who is it? Is it a German bank? Is it the Fed operating through the Bank for International Settlements, operating through Belgian intermediaries? I don't know the answer. It's a good question. I don't know the answer. If I find out, I'll put it on Twitter, and we'll all know. But it's clearly not the Belgians. So there's a propping up operation going on, and I do make that point. My book's only been out a month. I finished writing it kind of late last summer, did a lot of rewriting in the fall, even as late as December, put in new passages about what was going on with Iran and Saudi Arabia. So I think it's pretty fresh, but if you ask me what surprised me the most since the book came out is that the things that I talk about in the book are happening faster than I would have thought. I've got a China credit collapse, but I was kind of like, it feels like 2015. It's happening now. I've got a chapter on financial war. I said, watch out. It's happening now. So events are actually unfolding at a faster tempo than I would have expected. And this is an example of that. Yes, sir, in the back, the yellow shirt.
So for over 100 years, we've had the gold fix and the silver fix.
Right.
They just recently announced that the silver fix is going to go away in a couple of months. So what are the implications of that? What's going to replace that? And is there going to be something happening to the gold fix as well?
Well, the silver fix is ending. This is a group of a small group of dealer banks who sit around a room in London, and they're on the phone with their dealing desk, who are on the phone with their customers, and they set the price of silver and gold a couple times a day, and this has been going on for over 100 years. There are a lot of studies coming out, a lot of lawsuits pending that indicate that this has been used to manipulate markets. The data on that is pretty good. The banks are backing away from it. They're getting out of the commodities business. I think they've had enough fun. J.P. Morgan has incurred $30 billion of fines, penalties, legal and compliance costs for running a corrupt enterprise the past 5 years. Like I say, I think they've had enough fun with the government for now. So they're getting away from this, and the silver fix is being abandoned, as the gentleman said. The gold fix continues, but it is the subject of a class action lawsuit. I'm actually in touch with the lawyers who are leading that, and we're going to learn a lot, but it takes time. These lawsuits take years. I mean, first they have a motion the defendant has a motion to dismiss, and you got to have a hearing on that, and you got to meet a hurdle. I think it'll be easily met. Then you get into discovery, then you get the 10,000 emails, and then you hire people like me to read 10,000 emails and look for smoking guns, and it takes a while and that's all under gag orders and all that. So it takes a while to get to the bottom of that. So I don't know, but my gut would be that they would get rid of the gold fix also, and you say what would replace it? They'll just use the market, the COMEX or the spot market, dealer to dealer, intermediary to intermediary. That's manipulated also. When I talk about manipulation of the gold market, people go, oh, well, you believe in conspiracies, or you just don't like the price action, you're a whiner and all that. And I say, no. If I were running the manipulation, it's so obvious right now, I'd actually be embarrassed because the statistical evidence is piling up. This is no longer in the realm of speculation. There's a paper from two professors at Stern School at NYU. I met privately with one of the quants at a multi-billion-dollar hedge fund, and this guy was not a gold guy. He didn't really know that much about gold, but he was a PhD statistician, and he did a study, 10-year study, and he looked at the COMEX, that's where gold futures are traded, and then there's a spot market, and he said he had two hypothetical accounts, and one of them bought the COMEX open every day and sold the close. Buy the open, sell the close, so you go home flat with cash every night. The other account would buy the first spot tick after the COMEX closed and sell the last tick before the COMEX opened. and go home flat. So knows one account owned the COMEX trading, the other account owned the aftermarket. Anyone who knows anything about markets or statistics would say over 10 years, those accounts have to be identical. In other words, there could be daily volatility, but it's all got to even out. Those accounts are going to be about the same over 10 years. They weren't. The COMEX account was wiped out. The after-hours account made multiples of the actual action in gold. And so I said to this guy, I said, what do you think that means? I mean, I knew what it meant, but I wanted to hear him say it. He goes, well, it's manipulation. There is no other explanation for a result like that. And I said, well, thank you, because that's what I think it means. So the evidence is there. It's piling up. The lawsuits are piling up. The discovery's coming. This is getting increasingly uncomfortable for the banks. By the way, I don't think the banks are rigging the market. They're acting on behalf of the central banks. J.P. Morgan doesn't want to rig the gold market. They just want to make a spread. Goldman Sachs doesn't want to rig the gold market. They just want to arbitrage, the physical gold in the GLD warehouse versus COMEX futures. They can drive down the price and then buy the GLD shares cheap and short the gold and cash in the shares, get the gold, cover the short, make a spread. They're happy with that. But it's the central banks are behind it. The question is which one? I can think of reasons, when you find a body with a bullet hole in it and there are no witnesses to the crime, the first thing a detective does, he says, well, who has the motive? Then you figure out who had the motive and you go interview that person. If they're a little nervous, maybe you go a little further. So when I see the crime, but you don't know exactly who's doing it, you say who has the motive. Could be the Fed, but I think it's more likely the Chinese. Because as I showed in this slide, the Chinese are short 3,000 tons. If they want a big seat at the table, they got to get up here. If I was short 4,000 tons, I'd want to suppress the price too, because I could buy it up cheap. And that's what I tell investors. It's like, if the Chinese went out and bought 3,000 tons in the last 4 years, are they stupid, or do they see something coming that most people don't? I spent a lot of time in China. They're not stupid. So they see something coming, and I think for investors to have something like 10% of your investable assets in gold makes a lot of sense. Yes, sir, in the red shirt?
Forestall collapse, is it possible that quantitative easing will be restored? And if so, how much can the U.S. afford?
That's a great question. Earlier, the question is, can quantitative easing be put back? And right now we're on a path that's called tapering, where they reduce. Quantitative easing is buying bonds. The Fed doesn't use QE. They call it long-term asset purchases. It means they call it buying bonds. It's printing money, because when they buy the bonds, they print the money to pay for them. So it's just money printing. And that's what they've been doing. But beginning last December, they announced they were buying $85 billion a month. That's what they said. They were actually buying $90 billion, because for technical reasons they were paying a premium for some of the bonds. But so they started reducing that by $10 billion per meeting. So $10 billion in December, $10 billion in January, $10 billion in March, $10 billion in April. So they took out 40. So now they're down to 45. They'll certainly take out $10 billion in June. Now here's maybe a little insight that's helpful for market people. July is going to be the pivot. And what I mean by that is Yellen in her heart wants to pause. The Fed won't go from reducing to increasing in one meeting. They never do that. But they might pause. But in order to pause, you're going to have to run the table on data. You're going to have a bad May employment report, a bad June employment report, which will come out around the 4th of July, continued steep declines in labor force participation, and continued disinflation. If you get all four of those things, she might pause in July. But if either one of those employment reports come in strong or even decent, they won't, because they never act on one data point. They always want 2 or 3 or 4. So if you run the table, she might pause in July. But that's probably the less likely case. Probably some of the data will at least justify it because of the hawkish board. So they'll taper in July. If they do that, they're going to see it through, because at that point there's only $25 billion left. And with hawks on the board, why wouldn't you just see it through at that point? It's like your 25th mile of a marathon. You might as well cross the finish line. But they've tapered into weakness the whole way. By the Fed's own criteria, they shouldn't have started the taper in December. None of the indicia supported that case. Bernanke just wanted to wrap up his legacy with a bow and tie her hands. So if they keep tapering all the way through to November, December, whenever they finish it, the economy is going to be a wreck, and they will go to QE4 in 2015 with a much more dovish board. How much more can they do? That's a really good question. Legally, they can do as much as they want. I said they couldn't go to 8 billion, or sorry, 8 trillion or 12 trillion, but legally they can. And I had this conversation. Actually, one of the pushbacks I got when I was in London, I said they can't go to 8 trillion, and people say, why not? You know, why can't they just print 8 trillion? I mean, my answer is there's a confidence limit that they'll. I didn't really have time to go through that hypersynchronous icing model, but it doesn't take much to destroy confidence. Confidence is very fragile and impossible to regain. The last central banker who really understood that was Paul Volcker. But the Fed takes it for granted. So they might destroy confidence in the process, but they think they can do it. So they might try. They might just go to 5 trillion or 6 trillion. So I would look for, based on what I'm saying, I would look for QE4. They'll call it QE3 because it was always conditional, but it'll really be QE4 in 2015. I think they'll try. And my point is they're going to keep trying. It won't work for the reasons I described, and they'll run the car off the cliff. Yes, sir, in the back.
There's a proposal winding its way through the SEC to allow the float on the money market fund stable values. What kind of consequences do you think that might have
Yeah, I mean, I haven't looked at that particular proposal, so they're saying money market funds could break the buck. Okay, right. Thank you. Yeah, I mean that's a big deal. It kind of goes to what I was just saying about confidence. I mean, legally and economically, they should be allowed to break the buck. I mean, they're not insured deposits. Actually, bank deposits aren't insured. You know, they're insured up to a certain limit, $250,000, but beyond that, they're uninsured. I mean, bank depositors need to understand if you have more than $250,000 in a bank, you are a general unsecured creditor of a shaky institution. This is what happened in Cyprus, but it's the template for every bank in the world. It's actually been the law since 1933. But in a crisis, they suspend the law in effect and guarantee all the deposits and all the money market funds. Yeah, it's a really good question, but at the margin, I would assume that people would come out of money market funds and buy treasury bills or treasury bills. And that actually could be part of the financial repression where we need to pull out all the stops to prop up the government market. I mean, what happened in 2008 was that there was a train wreck in private credit, and we substituted government credit for private credit without solving any of the problems. But now we're looking at a train wreck in government credit, and we're going to have to prop that up. Yes, sir, in the front.
You talked about the Fed driving the car off the cliff. What does that look like for the economy? What does it look like for people?
Well, it's kind of a mashup of the 70s and the 30s. A couple things will happen. If you get the liquidity crisis, and it's bigger than the Fed, and the IMF has to print 5 trillion of SDRs, that is extremely inflationary. So for everyday investor, the fun thing about inflation is that it has an average impact. The economists call it money neutrality, but nobody's average, right? Everyone's in a particular circumstance. So what it produces are winners and losers. The losers are everyday Americans. So if you have a savings account, insurance policy, an annuity, a pension, a retirement income, you're one of the losers. From 1977 to 1981, in that 5-year period, cumulative inflation in the United States was 50%. The dollar lost half its value in that 5 years. People, you know, the Ron Paul crowd like to look at the creation of the Fed in 1913 and say, oh, the dollar's lost 95% of its purchasing power since 1913, which it has. You know, a dollar's worth what a nickel used to be worth. But there was a case where it lost 50% in 5 years. You didn't have to wait 100 years. And that could happen again. But interestingly, and I learned this studying the Weimar Republic hyperinflation in 1922, there are a lot of winners. Who would the winners be? Well, our friend Warren Buffett is a good example. Everyone, he comes off as this like avuncular sage of Omaha, I love stocks kind of guy. But look at what Warren Buffett's actually doing. A couple years ago, he bought the Burlington Northern Santa Fe Railroad. He bought the whole railroad, took it off the New York Stock Exchange. What is a railroad? A railroad is nothing but hard assets. It's land, right-of-way, mining rights adjacent to the right-of-way, track, rolling stock, signals, switches, yards, buildings, etc. It's all hard assets. How does the railroad make money? It moves hard assets, you know, corn, wheat, coal, steel, oil, etc. Buffett's next deal was to buy natural gas and oil resources, and now he can move his oil. He doesn't need the Keystone Pipeline because he can move his oil on his own railroad because you line up 100 rail cars, you got a pipeline on wheels. So Buffett is a guy who's dumping paper money as fast as he can, getting into hard assets. So he'll be like the German industrialists of the 1920s. When the Reichsmark went to zero, if you owned a factory, it didn't matter. A factory is a factory. It's a valuable asset even if your currency goes to zero. The government comes out with a new currency, you still own the factory. In fact, you go around, buy up all your competitors. There was an enormous concentration of wealth in the Weimar Republic, and then the German industrialists figured Hitler should be chancellor. He would make a nice pawn. That didn't work out too well. But that's what those are the winners in hyperinflation. So I look at people like the Chinese buying gold. I look at people like Warren Buffett buying railroads, oil, and natural gas, and I say these guys are getting ready for the day when the paper money collapses, and the losers are everyday Americans. Yes, sir.
I have a question about your chart of the major gold powers, starting with Euro, United States.
Yep.
And your chart is really about the official gold holding.
Correct.
About
33,000 tons, right?
But there's about 170-some thousand tons out there all told.
Correct.
And some countries have, like India, have a very small amount of official gold, but an enormous amount of unofficial gold.
That's right.
Same with Saudi, some of the Gulf states, some other places.
Correct.
So in a new world of gold, how do you want to balance the difference between official and unofficial gold to say who's a gold power in this new arrangement?
Right. It depends on the circumstances. I was gave a presentation like this at the World Bank in Washington on Tuesday, and I was cornered by a couple Indian economists. And, whenever I say India only has 500 tons of gold, I'm immediately pounced at, we have 15,000 tons of gold. We don't, not 500. And they do. But it's all necklaces around, daughters and wives. And, but and the World Gold Council, which are, this is where these numbers come from, they call that jewelry. I call it wearable wealth. In other words, it is your savings account. You're just wearing it around your neck, and it looks pretty. Look, one possibility is the government could go out and confiscate the private gold. That is what Roosevelt did in the United States in 1933. On his first day in office, he issued an executive order. He made it a felony for any American to own gold and confiscated it. And that's why they built Fort Knox. There was so much gold confiscated that there wasn't enough room in the Treasury, so they built Fort Knox in 1937 to store the gold. So that's one possibility. I doubt that will happen. I think the Indian people might push back a little bit. Saudi is different because the line between it's not a country, it's a kingdom, but the line between the kingdom and the royal family is blurry. So could they mobilize that wealth at the entity level? Possibly. So you might, I would give Saudi a much bigger seat at the table because they've got oil and gold. India, I think what happens is the country doesn't have quite as big a seat, but the people are better off. They're to this gentleman's question, they actually survive. In the United States, when we use the phrase old money, we're usually talking about a wealthy family like where the money's been around for 100 years, like the Rockefeller, like the Ziegler family in Darien. They've had that money for 125 years. That's the old money in the U.S. But when you go to Europe, you meet people who've had their family fortunes for 3 or 4 or 500 years. My last trip to Rome, I had dinner at the Palazzo Colonna. The Colonna family has had their wealth since the 13th century, so that money's been around for 800 years in the same family. It's a magnificent, it's kind of like plain stucco on the outside, but inside, man, you can't believe it. So how do you keep your money for 800 years? And because I asked them, I say, how'd you do that? Like, you guys survived the 30 Years' War, Louis XIV, Napoleon, World War I, World War II, the Holocaust. How did you do that? And they say, a third, and a third. 1/3 land, 1/3 gold, 1/3 fine art. And then a little bit of cash for your jet and your yacht and all that. And the scenario, so you're in Bavaria, and it's 1620, and von Wallenstein's in the next village, and he's burning down everything in sight. You take your gold, you put it in a pouch, you cut your painting off the wall, stick it in a backpack, you get on your horse, and you ride away. Come back a couple years later when the dust settled. If you had good title to the land, you should be able to reestablish title. Put your gold back on the table, put your painting back on the wall. You're rich and your neighbor's wiped out. That's how they survive. It's the difference between money and wealth, and I talk about this in the book. Money is transactional, transitory, vulnerable. Wealth is permanent and retains its value. And we tend to mush them together and say, I have a lot of money, therefore I'm wealthy. And I say, no, you have a lot of money, therefore you have a lot of money, but watch out for your wealth. That's a different question. Yes, sir. a lot. The if you're trying to rig markets, corruption and cronyism, can be good in their own way. But here's the point I would make, and this is where I kind of part ways with the White House. The White House is throwing these sanctions at Russia right now, and they say, this Putin, we're going to teach him a lesson, because the president said he was the kid in the back of the class who couldn't sit still. I'm not sure how Putin took that. He actually can't stand still. He invaded Crimea, but. The White House saying we're going to impose costs on the Russians. We're going to make them pay. Of course there are costs. You don't take over other countries without costs. Putin is not a wealth maximizer. He's a power maximizer. And one of the problems with U.S. policymakers, we've had 30 years of kind of free markets, kind of good growth, kind of prosperity, lots of MBAs cranked out. And I worry that our policymakers think that heads of state are like CEOs. They're supposed to, Jack Welch and Sam Palmisano are supposed to maximize shareholder value, and that Putin, he's supposed to maximize, shareholder value for the Russian state. That's not the way these guys think. As I say, they're power maximizers. You can play a negative sum game and win if the other guy loses more than you do. The U.S. thinks, well, everyone wants to play a positive sum game. Everyone wants to maximize their GDP and their wealth. That is a false premise. That's not true. And as I say, you can win a negative sum game. And let's just say that China and Russia incur costs in the course of confronting the United States in financial space. Well, aircraft carriers aren't free. I mean, we're building a new class, the Ford class of aircraft carriers. We're spending several $1 trillion on this over 20 years to build the support vessels and the port facilities and everything else we need to replace the Nimitz class of aircraft carriers. China has one aircraft carrier, and they haven't figured out how to land on it yet, so it's not very, the pilots are still practicing. But my point is, they might not spend their resources building aircraft carriers. They might be willing to take a few hickeys in financial war if they can come out ahead. So the fact that we're a fading democracy and they are, I just cut to the chase. I was out in Hayman Island out in the Coral Sea a couple years ago, one of these Davos-style events, and there's a lot of deep thinkers from around the world. And what's interesting about that, Danny Blair was there, Admiral Blair was former Director of National Intelligence, and the EU ambassador, and Chinese and Russian ambassadors, and all this. And the interesting about these meetings, when you're like really close in with a lot of power elites, ideas percolate. Like by Saturday night, the thing that everybody's talking about is nothing that was on the agenda. It wasn't on the agenda. It's just that lunch, dinner, drinks, these things emerge. And by Saturday night, the idea that emerged, the Chinese and the Russians stood up and they said, you Americans, you're so arrogant. You tell us about our Russian oligarchs and our Chinese princelings and our elites and our cronyism. You have cronyism too. You have elites too. You're the same as us. You just don't want to admit it. And so that became a theme, and I was saddened to see the Canadian ambassador joined in. I was like, hey, you're supposed to be our friends. And Admiral Blair and I had the Sunday morning panel. We called it The Empire Strikes Back. We kind of pushed back a little bit on that. But we do. We have our own elites. I mean, look at what Thomas Piketty's book. I don't agree with all of his conclusions, but he's right about income inequality. Income inequality today in the United States is worse than Mexico. When I grew up, Mexico was your classic oligarchical society, and now we're worse, measured by a Gini coefficient. So we've got unprecedented income inequality. We've got cronyisms. I think Jamie Dimon should be on a chain gang somewhere, and he's not. And I say that on television, by the way. It's not just for this. So my point is, you're right about China and Russia, but take a close look at the United States and ask yourself if we're any better. Yes, ma'am, in the back. Oh, when? Yeah, this is kind of, when will gold hit 7,000? That's kind of my call. This is kind of a 3 to 5 year thing. It's not a 10-year forecast because I don't believe in 10-year forecasts. It's not necessarily tomorrow. It could be tomorrow, by the way. The way dynamic critical state systems work is when they collapse very quickly. So if you get the catalyst, it could happen tomorrow, but I don't necessarily expect it tomorrow. But I don't think we're going to make it 5 years either. So, but here's the point. One of the questions I get, kind of a variation on your question, is, hey Jim, call me up at 3:30 the day before it happens, and I'll sell my stocks and go buy some gold. And of course, it doesn't work that way. I'm not going to know when it happens. I got a lot of calls in early January. Gordon Chang, who's a top-notch China analyst, a really smart guy that I follow, he said at the end of January, there's a certain Chinese issuer that behind these wealth management products that's going to default. And they did default. And a lot of people said, well, is this the snowflake that causes the avalanche? Is this the thing that makes it all come tumbling down? I said, almost certainly not. Because the thing that collapses the system is the thing you don't see coming. If you can see a default coming 25 days away, that's not going to take down the system because they'll fix it in the next 25 days or finesse it somehow. It's the thing you don't see coming. It's the thing you wake up in the morning and it's like, oh my goodness, I can't believe that just happened. And it all comes tumbling down. Now, here's the point about gold. When you really want your gold, you're not going to be able to get it. What will happen is, the price will go up $100 one day, and somebody will say, oh, that's interesting. It'll go up $200 the next day, and people on CNBC will say it's a bubble, and then it'll go up $500 the next day, and then before you know it, it's up $1,000 an ounce. And you're like, hey, I want some gold. You won't be able to get it. The big guys will get it. Countries, IMF, sovereign wealth funds, multi-billion-dollar hedge funds, they'll be able to get it, but the everyday investor will not. The mint will stop shipping it. Your local dealer will be out. There'll be a price that you can watch on television, but you won't actually be able to get it. So the time to get it is now. By the way, I recommend 10% of investable assets. Don't go all in. I don't believe in that. Don't go 50%. 10%, if you have 10% in gold and the rest of your portfolio and other stuff, if I'm completely wrong, right, there's kind of a floor under gold. It's volatile. I understand the volatility. If I'm completely wrong, you're not going to get hurt badly having 10% in something that kind of goes sideways. But if I'm right and this crashes and gold goes up 3, 4, 5 times, that's your insurance policy. So buy your homeowner's insurance now, and then hopefully the house never burns down. But if it does, you'll be glad you did. Yes, sir.
Could you share your view on Bitcoin?
Sure. My two least favorite topics are Bitcoin and Tesla. And the reason is, if you say anything negative, the true believers, it's like a religious cult, and you can't really have a normal argument about it. But and I get dragged into all these gold versus Bitcoin debates, which make no sense to me, because why don't we debate gold versus banana peels or Bitcoin versus peaches? I mean, this is as much sense as gold versus Bitcoin. But as a result of that, I've read all the scientific papers, I've read legal papers, I've met experts, head of the Bitcoin Foundation, so I know a lot about Bitcoin in spite of the fact that I hate the subject. So here's my take on Bitcoin. For users to use it as a currency, a couple cautions. First of all, I don't own them and I don't recommend them to investors. That's kind of where I'm coming from. Bitcoin has not been tested through a business cycle, through a downturn. It was invented in 2009. We've had nothing but growth since 2009. It's very weak growth, as I discussed earlier, but it is an up cycle. We haven't seen how it performs in a down cycle. All the other major asset classes, we have seen how they perform. So that's one caution. The other thing is that if you buy a Bitcoin for $200 and then you redeem it for $400 of goods and services because it went up, to $400, you have to put that on your tax return. That's a taxable gain. It's no different than buying and selling a share of stock. I dare say a lot of Bitcoin users, maybe most Bitcoin users, are not reporting that gain on their tax return, which means they're committing a felony. And we know that the NSA, we know from Snowden that the NSA is watching everything in the cloud. And we know from Lois Lerner that the IRS is used for selective enforcement against political enemies. So I wouldn't necessarily want to be a libertarian or conservative, not putting the Bitcoin on my tax return with the NSA looking over my shoulder and the IRS knocking at my door. So that's another thing for investors to think about. But I would, in its favor, I would make the point that Bitcoin is not just a currency, it's also a technology. And it's a pretty interesting technology. It's the great encryption, open source, widely distributed processing, very inexpensive. And so my analogy here, it's sort of like hominid DNA. Bitcoin, the currency, might be like the Neanderthals that die out, but the DNA, which is the technology, might turn into a modern human being. And I think this is why, I talked to Mark Andreessen about this, I think this is why Mark Andreessen and the Winklevoss twins are in it. Not for the currency play, but for the technology play, because you can use it to transfer anything. You can use the Bitcoin technology, not just to transfer Bitcoin, the currencies, but also stocks, bonds, securities, land titles, et cetera. So it might have a future as a cool technology, independent, and the currency might die out. I'm going to do one more question. Yes, sir, in the front.
The other major currencies, pound sterling, euro, Chinese yuan, and Japanese yen, Swiss franc, how do they play out in your
Well, I'd start with the fact that you don't see the UK on this chart. They have no gold, no significant amount of gold relative to their economy. So they will have a seat against the wall at the new Bretton Woods. They will not be sitting at the table. I understand sterling's been going up and is strong. We haven't had a currency crisis since the euro sovereign crisis in 2012, and Draghi put out that fire. So we haven't had a currency crisis. The cross rate is going up. Sterling's been pretty strong. In my view, the next currency crisis will be in sterling. Now, that doesn't mean it happens tomorrow. It might not even happen this year. And sterling could be stronger 6 months from now than it is today. So I'm not giving you a forward forecast on a cross rate. What I'm saying is the next currency crisis may be in sterling. The yen is going down because it has to. The U.S. is fighting the currency wars. We want a weaker dollar against all the other currencies. Except the yen, we've given the Japanese a green light to cheapen their currency because they're more desperate than we are. And if you do the math, and Kyle Bass has done this, to get the kind of inflation they want, see, everyone says you cheapen your currency to promote exports. That's not true. You cheapen your currency, in this case, to import inflation. You want to pay more for the stuff you buy, so the inflation feeds through the supply chain. In Japan's case, of course, it's energy. So you say, well, what percentage of the Japanese economy is represented by energy, and how cheap would the yen have to be for the increased price of energy to give us 2% inflation? The answer is cross rate would have to be 120 to the dollar. So it's going to go a lot lower. So I look for the yen to go to 120. Sterling might strengthen, but then that'll be the epicenter. Euro strong and getting stronger. I like Sing dollar. I like Korea. I used to have Australia on my buy list, but I took them off because the RBA got in the currency wars, although they're thinking twice about that. But my favorite currencies are the euro, Sing dollar, and Korean won. Thank you very much.
Thank you all for coming. If you'd like him to sign a book, he'll be at the table in the back of the room, and hope to see you next Wednesday for Stephen Roach. Have a good evening. Yes, 8 o'clock in the morning.
Do I need to register?
It would be a good idea, but I know people. So there'll be plenty of room. Yeah, very good. Oh, man. Wednesday, 8 o'clock.
I got up at 5 and now I don't.
I know, we were in Chicago. My husband would get up at 4:30 in the morning. So moving here was like, whoa, sleeping in. Anyway, it was good to see you here.
So how's everything going? I know I only emailed.
Oh, I know. It's great. How are things going? They're going
Are
fine.
they settling here now?
Settling a bit, yeah, I'd say so. Along. There's always change. Inevitable.
Inevitable, right, yeah.
But things are good, and I'm glad you guys are back for another season.
Yeah, I guess so. I thought the one speaker. So far.
Oh, for great decisions, yeah. Oh, man, we were so sabotaged by weather last year. And it was so early. And world events, it's going well.
Yeah, I mean, we're sort of up and down. The attendance sometimes very strong, sometimes not as strong. I think it depends on the book. But I don't choose a book based on its necessary popularity, but on its real meat.
Yeah, they're
Some of them are very challenging.
The people who do come, it's really very
Yeah, people who come
How
are
about
very
you?
We are. I sent you the email.
Oh, okay.
Yeah, yeah. September is Lewis' book, Flash Boys.
Yeah, I saw that. I printed it out. I forwarded right to Lauren and Amy. I said, let's get these ordered.
Very controversial science Times writer, Nicholas Wade. Troublesome inheritance on the genetics of the races. Very interesting. Yeah, there is. Yeah.
More than one.
But but a lot of he's got a lot of solid grounding in what he's saying. What I think you can take out of it is that the system's inherently unstable because of what they've done.
Yeah, I think nobody can argue with that.
You know, which way it may go, it's hard to say, will we go with major inflation and collapse that way?
No, should I do that now? What do I hit? Same thing? Just put, I turned it on?